Hey, fixed guys, it's me again. Hope you enjoyed my last video. Now it's going to be a little bit different. It's going to be about what I call bond bureaucracy, that's the term I'm using. And what is this bond bureaucracy, right? Bond bureaucracy is what kind of sectors, right, market practitioners are using, right, in order to classify bonds, right? So we have this big box here, which are called bonds, okay? And now we are classifying them based on, first on the category of the issue, right? So we said in class that we have basically US government here, right? Then we have basically sovereigns and their, cohorts, right? And then we have the agencies. And then we have our good old corporates. Right? So it used to be basically that in the early days, it was only corporates that were issuing bonds. Now, because everybody are indebted, all of these guys issue bonds, right? So now we said that the sovereign bucket, right, and the corporate bucket is basically one big bucket which market practitioners call credit. Now, it is important to understand, right, that in this particular situation, okay, the sovereigns are not the US government, but the sovereigns which are basically residing outside the United States, right, and issue bonds, right, inside the United States in dollar denominated, right? So if you have a Brazilian government and you're searching for that, you go to the United States market and you're, issuing bonds. If you're Petrobras, right, which is basically an energy company associated with the Brazilian government, it will be part, of the sovereign bucket. Okay, corporations are not backed by any government. And now, of course, I forgot something, and you have to excuse me, because it's the age. It's a securitized bucket. Most of the interest, right? Well, not now, but most of them were, concentrated on these corporates and sovereigns, right? So we said that inside the sovereign, right, we have all kinds of buckets. We have basically, the sovereign itself, but you can also have like quasi, government-backed agencies. Right? So this will be kind of a quasi-sovereign. It's called government-sponsored. It has many names, but that's the idea. Okay? And then corporations have three big buckets based on their industry, right? So the first one is industrial. Then you have the utility. And then you have the financials. And then the industrial bucket is actually broken even more, right? You have the tech companies, you have all kinds of companies, but, I don't want to go too deep because, when you will go to your job market, they will teach you, all this deep stuff. All I need to do is just to give you a general picture, okay? Now, how do we measure, okay, so these guys are based on industry. Now, and this is basically what I call the Barkley/Merrill classification. Now, as I told you in class, we have different classification. Bloomberg, for example, uses its own classification, which is more palatable for stocks. We have also a classification of the government, which is a standard industrial classification, which is done by the government. But this how the market participants, right, view the market. That's how they think about bonds. So if, for example, they want to buy a bond, right, they will think about, okay, is this a corporate bond? Is this a sovereign bond? Is this part of the credit bucket? Where do we need to position ourselves with respect to the market? All this top to bottom approach, okay? Now, I also said that how we measure riskiness of bonds is based on ratings, okay? So we have three major agency companies. We have the S&P, Moody's, and we have the Fitch. Fitch is a little bit, smaller, okay? And those companies, they took a look on every bond which is issued and they assign a rating to it. Now, they don't assign rating immediately, but after 2-3 weeks they assign a rating, and the ratings are basically based on their riskiness. So you have two big categories, the investment grade, and here you have the high yield rating, right? And the investment grade is basically all the AAAs, then all the AAs, then all the A's, and then you also have, the triple B's, and below triple B, you go to the high yield bucket. So you have double B in the high yield bucket, B, and then triple C and beyond, right, until you get to the distressed debt. Right? Now, what is very interesting, okay, that those guys, what we call are traded on spreads, right? So these are spreads based, when you go and you quote the market, right? You quote the spread. You will say, okay, I sell this bond with this in this spread. Let's say 100 basis point spread, right? And the spread is whatever you have above the treasury with a corresponding maturity. Of course, it's not, very exact. Once again, I told you, right, that market participants that chase basis points, okay, they will actually bash my, my definition. But morally, right, I think I'm correct, okay? And the 90%, I think I'm correct. And here, right, the triple B, okay, is also traded on spread. But B and B below is what we call traded on price. So it means that if you have a GE, right, which issues a bond, and you want to buy this bond, you will say, okay, you quote me a spread of 100, I think that the spread is 90. And then on the spread, the 95, right, you will converge, and then somebody will calculate the price for you. However, for B and beyond, when you will call, it will be like stocks. I sell this bond for 95, I sell this bond for 96, I sell this bond for 80. Okay? So that's all there is to it, and I hope you enjoy this video. Pretty short, but pretty useful. Thank you, and have a great day.